Hey guys, in this video, I'm going over my 6 top stock picks for the month of November 2020. I've done all the research for you, and this is the list of stocks that I think will see great growth. Be sure to watch all the way through to get my full analysis on each of these stocks. I'll go over the key numbers, the recent news, and my future outlook of each company. Big shout out to Trends for sponsoring this video. So let's get started. First up on my list is Etsy, stock ticker ETSY. This is an American e-commerce website that is more focused on handmade and custom items. I've talked about Etsy in my previous videos and they've grown tremendously, but in my opinion, it's still a great buy with a lot of upside, and that's why I keep buying more and more of it. Right now, Etsy is trading at $139.73 with a 52-week low of $29.95 and a 52-week high of $154.88. If we take a look at their 1-year price chart, you can see that, at the end of last year and at the beginning of this year, they were hovering about $50 per share. With the pandemic, they took a big hit, but since then, this stock has grown tremendously. Etsy has a market cap of $17.694 billion with a PE ratio of 109.25, which is very high, an earnings per share of $1.28, and they do not currently pay out a dividend. They have a 5-year price to earnings growth ratio of 3.4 and a price to book ratio of 32.84. Looking at their profitability, right now they have a profit margin of 13.78% and a return on equity of 32.08%. In terms of their balance sheet, they have a total cash of $1.04 billion and a current ratio of 4.27, which is actually very strong. This means they have over 4 times the current assets as current liabilities. It's always interesting to see what analysts have to say about this. So on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts currently rate Etsy as a 1.7, meaning it is a pretty strong buy. And the average analyst price target is $153.12, which is about 8% higher than the current price of $139.73. Now, Etsy is a fast-growing e-commerce company that has a great niche and is also really growing in profitability. You can see in this chart just how much e-commerce sales have grown compared to retail. And as someone in e-commerce myself, I do not see this stopping anytime soon. This latest quarter, total revenue is up 137%, all the way to $430 million, and gross sales increased 147%. Active sellers also grew 35%, while active buyers grew 41%, which is amazing. E-commerce is very competitive, but Etsy has carved out a niche that no one can really compete with by focusing on handmade, custom, and vintage goods. Amazon even tried before, but they were unsuccessful. One thing that people say is that their sales are only up because of the huge amount of masks that are being sold on their platform. $346 million worth of masks in Q2 to be exact. But the truth is that all sales in other categories are up significantly as well. Plus, masks was the perfect way to get new buyers onto the platform, and with a 51% increase in repeat buyers this last quarter, that gives lots of future business as well. There's a ton of room for Etsy to continue growing as a company, and I see them having sustained long-term growth and rising profit margins for years to come. That is why I think that this could be a great stock to pick up for both the short term as well as the long term. All right, next up on my list is the company QORVO, stock ticker QRVO. This is an American semiconductor company that designs, manufactures, and supplies radio frequency systems. So as a result, this is a company that is benefiting greatly from the 5G rollout. Right now, QORVO is trading at $134.45 with a 52-week low of $67.54 and a 52-week high of $140.69. If we take a look at their 1-year price chart, we can see that at the end of last year and the start of this year, they were actually trading between $110 and $120. They took a big hit with the pandemic, but since then they have risen quite drastically. QORVO has a market cap of $15.359 billion, a PE ratio of 40.64, earnings per share of $3.31, and they do not have a dividend yield. Their 5-year PEG ratio is 1.83, and they have a price to book ratio of 3.54. Now, in terms of profitability, QORVO has a profit margin of 12.05% and a return on equity of 9.02%, which is pretty mild. They have total cash of $1.14 billion and a very strong current ratio of 4.08. As far as analysts, they currently rate the stock as a 2.2, meaning it is a buy. And the average analyst price target is $141.55, which is about 5% higher than the current price of $134.45. So like my previous videos, I always try to include at least one 5G stock because I really believe that 5G is going to be a huge game changer. QORVO supplies chips to companies like Apple and Samsung, and even Huawei. In fact, 60% of its revenue last quarter was from mobile chips. QORVO continues to increase their guidance for both earnings and revenue, expecting to make about $1 billion in revenue this quarter, with an earnings per share of $2.14. This is about 8% higher than its previous estimates. And it's also way above last year's revenue of around $800 million. Analysts do expect earnings to grow another 39% when the next reports are released. 5G devices should be about half of smartphone purchases by the year 2025, which means that these next few years could be huge moneymakers for this company. Yes, the PE ratio is quite high right now, but it makes sense given the huge growth this year. I do think the momentum will keep up for QORVO in the next few years at least due to this 5G rollout, and that should present some great gains for the stock. That's why I've been adding them to my portfolio. I just wanted to take a quick second and thank this video's sponsor, Trends. This is a super cool platform from The Hustle that I've really enjoyed using. When you subscribe to Trends, you get access to a community of industry leaders in almost every field, and you can also find trending and emerging opportunities for new businesses. I'm obsessed with their signals page, which gives you the latest trends. If I were an entrepreneur looking for new businesses to start, this is where I would get my ideas. For example, making a breathwork app right now might be a great industry to get into based on the increasing search volume, which you can see on this graph. They even give you ideas of how you can capitalize on the trend. Another cool signal was for boho, and we can see the search interest skyrocket in the last half year. This could also present some major opportunities for a business venture. They also have premium articles, hour-long live training sessions with slides and transcripts, networking with other entrepreneurs and investors, and so much more. I've gotten a lot of value out of this community, and I've interacted with many leaders that I normally would not be able to get in contact with. So right now you can get your first 2 weeks for just $1. Go to trends.co/Charlie for your $1 2-week trial. All right, 3 on my list is Chewy, stock ticker CHWY. This is an American online retailer of pet food and other pet products. If you have a pet, then you've probably heard about them before or you've bought something on their website. So right now Chewy is trading at $63.49 with a 52-week low of $20.62 and a 52-week high of $74.84. Taking a look at their 1-year price chart, we can see that this company has just grown so much in the last year, going from under $30 per share all the way to its high of around $60-$70. They have a market cap of $26.189 billion, an earnings per share of -65 cents. They don't have a PE ratio right now, and they also do not pay out a dividend. In terms of profitability, Chewy is still not yet profitable, and their profit margins are at -3.74%. They have total cash of $153.84 million, and one thing I don't like about them is that their current ratio is quite low at 0.61. This means that they do have more current liabilities than current assets. As far as analysts go, they currently rate Chewy as a 2.1, meaning it is a buy. And the current average analyst price target is $64.27, which is about 1 to 2% higher than the current price of $63.49. Over the last year, Chewy stock has grown almost 150%. So this is one of those companies that has really been doing well. As a pet owner, I am seeing a growing trend of people purchasing things for their pets online. And when 37% of online shoppers use Chewy for buying pet stuff, you can see why this is a valuable stock. In the news recently, we saw a spike in Chewy's stock price when a new $100 price target was set by an analyst over at Jefferies. However, this sentiment isn't shared by all analysts. Many are also rating it as a hold versus a buy. But overall, Chewy stock is considered a buy among analysts. So I am part of the generation of millennial pet owners that increasingly purchases all their things online, including pet stuff. And with their great website interface and customer service, Chewy is definitely the leader in the pet e-commerce industry. In the quarter ending August 2nd, their net sales have increased 47% year over year to a total net sales of $1.7 billion. This is a big company with over 17,000 employees nationwide. One thing that I really like in their business model is their subscription service. People can order regular deliveries of their favorite products, bringing in consistent cash flow and profits. In fact, over 2/3 of its net sales are from subscribers. Like I mentioned earlier, Chewy is not yet profitable, but it will be soon in my opinion. This quarter it lost $32.8 million, which is much better than the $82.9 million loss the previous year. So we are seeing a trend in reaching profitability. Yeah, overall I see great upside with the stock, and that's why I think it could be a great buy for November 2020. All right, next up on my list is Abbott Laboratories, stock ticker ABT. This is an American multinational medical devices and healthcare company. You may have heard of them as one of the contenders for the vaccine, and they have been crushing it this year. Right now, Abbott Laboratories is trading for $109 with a 52-week low of $61.61 and a 52-week high of $114.20. Looking at their one-year price chart, we see a big drop in March, but of course, they've really risen dramatically, and they're pretty much at all-time highs right now. Abbott Laboratories has a market cap of $192.988 billion with a high PE ratio of 57.64, an earnings per share of $1.89, and a mild dividend of 1.34%. They have a 5-year PEG ratio of 3.39 and a price to book ratio of 6.24. Right now, their profit margins are sitting at 10.5%, and they currently have total cash of $5.04 billion. Analysts give the stock a 1.9, meaning it is a buy. And the average analyst price target is $116.47, which is about 7% higher than the current price of $109. Q3 numbers were recently released, and it's a lot of good news for investors of Abbott Laboratories. For Q3, they reported adjusted earnings of 98 cents per share, which beat estimates by 7 cents. This is much higher than 84 cents per share the previous year. They also had $8.9 billion in revenue, which came out to a year-over-year growth of 9.6%. Abbott's small dividend could definitely be higher, but it has a great history of paying it out and seems to increase consistently, which investors do like. And in the news, recently the FDA granted emergency use authorization for its 7th COVID test, which is an antibody test. This is definitely good news for this company, and their product pipeline is performing extremely well, and the momentum does not seem to be stopping. Now, Abbott is a leader in the pandemic diagnostics tests, which makes sense why its diagnostics business was its top performer this past quarter. For the upcoming quarter, Abbott has released its guidance, and if it holds true, then we could likely see some gains for the stock. They predict their full-year adjusted earnings per share to be at least $3.55, which is about 7% higher than the current analyst predictions. Overall, I will be adding more of this company to my portfolio because analysts like this company. It's got great momentum in numbers, and I see a good future for its stock price. Okay, next up on my list is CHEGG, stock ticker CHGG. This is an American education company that was founded in 2005. They have textbook rentals, tutoring services, study materials, and a lot of other services available on their website. So right now, CHEGG is trading at $86.69, even though they did drop to $83 after hours. Their 52-week low is $25.89 with a 52-week high of $89.99. Looking at their one-year price chart, we can see that this stock has absolutely killed it this year, going from around $40 per share all the way to where it's now between $80 and $90. CHEGG has a market cap of $11.141 billion with a PE ratio of 6,668, which I guess is that way because they have barely any positive earnings, and earnings per share of 1 cent and no dividend yield. Their 5-year PEG ratio is much lower at 1.93, meaning we are expecting to see a lot of growth. And their current price to book ratio is 22.37. Right now, they have a very small profit margin at 0.32%, and their return on equity is also very, very low at 0.34%. Balance sheet wise though, they're doing extremely well with total cash of $702.59 million and a very, very safe current ratio of 8.2. Analysts also really like the stock. They rate it as a 1.9, meaning it is a buy, and the average analyst price target is $93.93, which is about 8% higher than the current price of $86.69. So obviously with this pandemic happening, we've seen some huge shifts in some industries. Although I think online education was already picking up tremendously before March, the pandemic really kicked the transition into high gear. The thing is, for most people, you don't need to be somewhere physically to learn. As students are going back to school online, this opens up doors for companies like CHEGG that specialize in everything online education based. This direct-to-student educational platform saw its user base jump significantly, with Q2 sales up 63% and subscribers up 67% to 3.7 million. Earnings were also released for the last quarter with an earnings per share of 17 cents, which was down 5.6% on revenue of $154 million, which was up 64%. Now, CHEGG released its rest of the year guidance and expects to see Q4 revenues of around $188 to $190 million, which is above analysts' expectations. We should also see its earnings per share increase. Overall, this was extremely strong performance, but we did see a small decline in share prices after hours. If I put myself in the shoes of a student who now goes to classes online, I'd 100% be looking for resources online as well. With CHEGG having such a good selection of services at affordable prices, I would surely use them for tutoring, for my textbooks, and for my study guides. And then once school returns back to normal, I'll already be hooked to these low-cost services and prefer them over in-person tutoring and study sessions. So yeah, in the long term, I think that CHEGG has huge potential and will take over the online education industry. In the short term, I think it has great potential to grow, but the long-term prospects are even better. All right, next up on my list is Alibaba, stock ticker BABA. This is a massive Chinese tech company that has businesses in e-commerce, retail, internet, and technology. I've covered them in the past and they've done extremely well, and I think there's still a lot of room to grow for this company. I'd say it's pretty much like the Chinese Amazon, owning sites like AliExpress, Tmall, and Taobao. So right now, Alibaba is trading at $306.87 with a 52-week low of $169.95 and a 52-week high of $315.46. Its one-year price chart shows extremely strong growth, almost doubling in the last year. Alibaba has a market cap of $823.673 billion, a PE ratio of 32.96, and an earnings per share of $9.31. Right now, their 5-year PEG ratio is 1.49, and they have a price to book ratio of 6.85. Profit-wise, Alibaba does quite well with a profit margin of 32%. They also have a very high return on equity of 21.51%. And I do like their pretty strong current ratio of 1.98. Now, analysts do really love the stock and they rate it as a 1.6, meaning it's between a buy and a strong buy. And the current average analyst price target is $322.18, which is about 5% higher than the current price of $306.87. In the last year, Alibaba stock has gone up 85%. But this doesn't mean that their growth is stopping anytime soon. Alibaba is perhaps one of the most diversified businesses in China. They own Tmall and Taobao, making money off listing fees, advertising, and direct sales. Right now, its e-commerce businesses generate almost all its revenue, and it's the only profitable sector in its businesses. However, some of the other businesses, like its cloud computing services, are expected to turn profitable in the next few months. This presents considerable upside to its earnings, which is already doing quite well. This next quarter, ending in December 2020, expects to see revenue growth of 51% and 38% in 2021. They recently just invested $3.6 billion in grocery company Sun Art Retail Group, which is a Chinese supermarket company. These grocery stores are integrated with Alibaba's online platforms for quick delivery. And I do think that grocery delivery is a booming industry in China. They also own a 33% stake in Ant Group, which is making its mega IPO very soon. Alibaba has been expanding into China's poor cities with Taobao Deals, which hit 45 million active users last quarter. And if you take a look at all their retail and online marketplace operations, revenue is up significantly across the board and does not seem to be slowing down. Whenever I find a company like Alibaba that is taking over a country in industries that are rising, I always look at it and think of it as a very, very great long-term investment. And that's why I think Alibaba could be a great stock to invest in this month. I know I say this in all my investing videos, but before buying any stock, I want you guys to do your own due diligence and not just rely on what I'm saying in this video. Use this video more for guidance and for inspiration, and do your own research. Definitely do not buy any of these stocks just because it's on this list, because if you watch my investing strategies video, you'll see that that is not the right thing to do. Anyways, happy trading, you guys. Make sure to diversify your investments, buy some ETFs, buy some index funds, but also if you want, take a gamble on some individual companies as well. I really hope you guys found this video informative and helpful, and if you did, make sure to hit that like button and also subscribe to my channel to see more videos like this. I make a ton of content about personal finance, investing, and entrepreneurship. So yeah, I would love for you guys to join. Anyways, that's it for today. Thank you so much, and I'll see you in the next video. Peace.